economy. So let's kick this off, guys. Let's have some fun and talk about how $68 trillion on the low end is going through the American economy in the next little bit. First things first, we always got to keep our attorneys happy. So I'm going to read you a little bit from our legal team to make sure that we check that box. We are not investment advisors, and this seminar is provided for educational purposes only. All investments involve degrees of risk. You should be aware of your risk tolerance, your tolerance level, and financial situation at all times. You are free to accept or reject all investment recommendations made by us. All services that we offer are subject to market risk and may result in loss of your investment. As you know, a recommendation is not a guarantee for the successful performance of an investment, and we cannot guarantee against losses arising from market conditions. Past performance does not guarantee or ensure future success. Okay, attorneys are happy. Also, we've never missed a distribution to investors, and we're very proud of that as well. So I always like to brag about that at the end. So let's jump into it. We have a lot to go through. We're going to make good time, and it's very dense material. So we want to start off with a bang and just set the stage for what we're going to be covering today and what generations are involved in this. First things first, what are we going to cover? We're covering the most unprecedented wealth transfer in the history of not the US, the world. Okay. The dollar figures we're talking about today are staggering as it relates to not just the next decade or 10 or 20 years, but human history. That's how massive these wheels are turning and the shifts that are taking place. Next question that we'll cover is, how is this shift? We've been dealing with inflation for years, inflationary forces that we haven't seen in 4 decades. Right? We're dealing with steepest increases in rates that we've ever seen, not the highest, right? Some of you might remember the 70s and 80s, but the steepest by far, things like that that are based on inflation. So how does this, tens and tens of trillions of dollars entering the market, how does that impact inflation, and how will that impact inflation moving forward? Also, we'll cover, why is this happening? Who is most impacted by these dollars and these market shifts? And most importantly, the number one point we want to end with and hammer home for everybody that's here today is, what are the things that you can be doing about this? How do you make the most of these shifts and these economic changes that are occurring so that you, your families, your portfolios are in the best place possible for your future with all the information that you get? Because if you get information and you don't apply it, then what did you just do? Right? It's at that point, it's you just having fun and being entertained more than educated. So our goal is that you apply this. Now let's set the stage as far as some details here. The first thing that we're looking at is a breakdown of generations, right? The largest wealth transfer is from the boomers, the baby boomer generation, to the younger generations primarily. So what is a baby boomer? Many people in our attendees today are baby boomers. We appeal most to baby boomers by demographic on the Saint side, but just to define the age ranges, we're talking about 60 to 76 is the most common age range definition, but really it's right around 60 to right around the upper 70s. That's what baby boomers are considered by and large. Okay. The estimated net worth of the baby boomer generation is the most we've ever seen in history, and it's also the largest generation. So we're talking about the baby boomer generation being the wealthiest generation that we've ever had, and also the largest generation we've ever had by a wide margin. Okay. So the baby boomer generation at their peak was 78 million in the United States. Sadly, we've lost some of our beloved boomers, and now it is just dipping below the millennials, which is the second largest generation we've ever had. Baby boomers are now less than the millennials at the 72 million person figure. Let's understand the baby boomers a little bit more by understanding what came before them. Okay. So in this in this chart, we're seeing that before the baby boomers was the silent generation, a great generation for many reasons. But what we don't see in this chart, because this is mostly showing where the money is going, what we don't see in this chart is the generation called the greatest generation. This is the generation that are the parents of the baby boomers. Again, we have many baby boomers that are attending, so this isn't news to you. But the greatest generation was born between 1900 and 1927. Can you imagine what they saw in their lifetime? Okay. This is a generation that was born in the midst of the Great Depression. That was their entrance into the world, was experiencing the Great Depression in the United States. Then, when they become adults, they fight in World War II. That's why they're called the greatest generation, is because frankly, they freaking earned it, right? Think about what that would create for a generation. Let's talk some things that are attributed to the greatest generation. Toughness, self-made, conservative, efficient financially, right? So when this generation had seen all these wild, crazy, difficult things in their lifetime, by the time they came back from World War II, they had seen enough excitement for one lifetime, right? So they come back from World War II. What's top of mind, right, is really to settle down after all the things that they had experienced. So what did that look like? Lots of kids, conservative lifestyles. Remember, these weren't big spenders. These were people that came of age and grew up during the Great Depression, right? So big focus on the family from this generation and having a lot of kids. Many of the greatest generation were either farmers or parents were farmers. So having many children was a cultural expectation or something that they were very used to, right? Not only that, the bigger, broader trends in the world were in their favor as well. Think about post-World War II. Most of Europe was decimated, destroyed, right? Many parts of the world, in fact. We in the US were kind of insulated. Sure, we had Pearl Harbor. Sure, we had a huge loss of lives, right? We had many alarming things that came along with that. We had huge amounts of money that went into the war effort, but not our cities decimated, right? We weren't in rubble like a lot of Europe. And we kind of exited the war as the world power, as the economic power, as the military power. So the greatest generation coming home and having all these kids, the baby boomers started at an amazing place, at a very, very, very strategic and important historical place. So I want to give that backdrop, right? The greatest generation, the parents of the baby boomers, right? And kind of what was experienced up until the point. So how the heck did baby boomers accumulate so much wealth in such a gigantic generation? There's a number of reasons for that. Now, some demographers split the baby boomers into early and late baby boomer periods. For the sake of this presentation, it's just the baby boomers. We're just using that set window that most of the time that we're referring to overall, anytime someone says the baby boomers. The baby boomers, 60 to late 70s, came of age in an amazing window of time that we kind of outlined before. That included lower cost of living, right? Just the average amount that Americans spent to keep their lives moving and on groceries and on gas and on cars and all of the above. It was just lower at that period of time. Lower debt per person. Today, you might have seen the headlines. We've reached consistent levels of record debt in the US. Consistently. That's just an upward trend that we've been dealing with for several decades. Okay. Lower cost of education. College wasn't as expensive. So naturally, the ROI is going to be higher, right? And then this one's very important, lower cost of mortgage versus incomes at the time. The percentage of incomes going to a mortgage to purchase a house was much lower than it is today. So what does that equal? Lower cost of living means more money for savings and more money to grow the family. So baby boomers, coming from a booming generation of babies, also had big families. I'm a millennial. I'm a product of you baby boomers having lots of kids, right? So big families on the baby boomer side. Lower debt per person means less stress on the household. That allows baby boomers to have more kids, do things like invest, right, into other things. Think more broad about life rather than just monthly bills. Lower cost of education means less debt. We already touched based on, and then lower cost of mortgage per person's income at that time means more access to home ownership, which for many Americans is the greatest asset that they will ever own in their entire lifetime. So having that degree of access and great situation that was paid for by World War II, that was paid for by the Great Depression, that was paid for by all these things, allowed the baby boomers to step into a very strong period of American history. And it's not just the economic forces. Think about what they inherited culturally from the greatest generation. Tough mindset, strong work ethic, right? Being raised tough, all things that they got from the greatest generation mixed with a fantastic economic environment for not just the US, but them as a whole in the world, created a very powerful time for them to thrive. So that's a little bit of the backdrop of what baby boomers stepped into from the beginning, and how they figured out ways to have such access to finances and investments along the way. So not a whole lot to say here. This is pretty self-explanatory, but it's pretty telling and pretty powerful. This is the graph of breakdown by generation in America and the US today. So silent generation before, baby boomers around 18 trillion, baby boomers 78 trillion. Okay? What a staggering number. Just to give you guys a little perspective on this, the US, the entire United States GDP is roughly 25 trillion a year. So this number that we're staring at right here is 4x that, right? Or 3x that, excuse me, over 3x that. So we're looking at a staggering number, a staggering amount of cash entering the market over the next period of time. Also, you can see Gen X, not quite. Okay, just checking on a note. Not quite where the baby boomers are at, right? And then you see the millennials actually pretty far behind. We'll get into some statistics of what that looks like. And again, we're talking decades between these generations, so there's still a lot of time. Some estimates place the millennials very far behind, especially in certain categories. Some estimates put them, further ahead. Gen X the same. We'll show those trends as a breakdown a little bit later. But one thing I do want to point out is right here we're seeing 78 trillion, and the title says 68 trillion being passed down, right? Let's point out the difference of why those numbers are not the same. 68 trillion is the estimated amount that will be passed down generationally from the baby boomers. 78 is towards the upper end, because what we will also see, and we'll get into a little bit, is that the baby boomers also plan on some philanthropic giving. So not all of that 78 trillion is to be passed down. Also, we have this thing in the US called death taxes, right? That's factored into a degree. So a little bit of all of that takes us from 68 or from 78 to 68. So what is happening in the country with inflation? Because this is important to understand the backdrop when we're talking about huge dollar figures that directly impact savings, that directly impact investment, and especially handing money down from one generation to the other. One of the reasons that's less positive for the way that, let me word that differently. One of the reasons that the baby boomers were able to amass such wealth over the course of their lifetimes, that's actually a less positive cause, is because baby boomers have experienced huge periods of time of massive inflation. Let's talk 70s and 80s, right? Let's talk 2022, where we capped inflation at 9.1% within 17 months of being under 2, right? So the baby boomer generation has dealt with some of the most turbulent inflationary environments. That's bad for cash, but that's good for assets, isn't it? Right? So you look at your home, for instance, right? We'll go through some of these numbers shortly, but inflation in real estate is a natural hedge against inflation, and baby boomers hold a lot of assets and did so from an early place, an early age in their generation. So money is always in motion. Understanding the inflation backdrop is important with this story. So as we dig into the backdrop here, we're blessed. We get to work with a lot of amazing investors. Many extremely sophisticated people, have extremely sophisticated discussions with them, and have a great network of people that we get to learn from also, or we get to see what they're looking at. One of the biggest trends that I'm seeing in highly sophisticated investors right now is they do see this trend already coming. It's that the inflationary pressures that we're looking at are not just a short-term Federal Reserve solution. We're talking about 10, maybe even 20-year trends of inflationary pressures. Okay. Where does that leave us, right? If we have upward inflationary pressures for a longer period of time, well, we could have high inflation, right? Or we could see what the Federal Reserve is doing, which is the steepest rate hike in history, not the highest. 70s and 80s hit about 20%, but the steepest, the most rate increases in a short period of time. That happened in the last handful of years, right? What that will lead to is the Federal Reserve, which is, the arm of the government, pseudo government agency, stepping in and making something happen, pulling some degree of a lever. And the lever that we've seen them pull has been rates, clearly, right? So if inflation isn't peaking at these crazy numbers like 9%, then we can expect higher rates. What that might look like, we'll get to that chart in a second. What that will likely look like is the rates we've been experiencing. Right now, we're anywhere from the high sixes, 7, we're flirting with that on the retail market, right? When you buy a home, that's what you're kind of seeing today. Wow, what a huge increase from the 3% range that we were experiencing just a few years ago. Massive increase. But if you spread the chart out, and many of our boomer friends that are attending today will know this, if you look further down the chart, 5, 6, even 7 a little bit, it's kind of just a return to norm. That's kind of the historical norm if you look at mortgages in the United States. But the difference is we have inflationary pressures where that's not even solving the problem. The most recent CPI, Consumer Price Index, which is the index that we look at for inflation tracking most commonly, is right about 3%. So after the steepest rate hikes in history, we still have sticky inflation. Now, we might say, oh, well, the Federal Reserve's aiming for 2%. We're only at 3%. It's not 1%. It's actually a 50% increase. Because if you look at a federal funds target of 2%, a federal CPI target of 2%, and we're at 3, that's 50% above. That's a 50% increase from 2 to 3. And Jerome Powell knows it. So he's in a tough position because he has to manage all kinds of spinning plates, including unemployment numbers, including inflation, including some underlying factors we're going to jump into. So we'll talk about what the Federal Reserve told us in other areas of the market, but let's give them some kudos first before we beat them up too bad. The first thing is that they do attempt to give us a lot of transparency through especially their dot plot. This, what we're looking at right now, is the Federal Reserve's dot plot. Okay. What they do with this, the Federal Reserve Committee has different members that vote. Can you guys see my cursor on the screen by chance, Ange or Luke?
Yes, we can see it.
Great. Okay. So each dot here represents a vote by a Federal Reserve Committee member. What they're doing in this dot plot, it shows different periods of time, and it shows what they expect at the Federal Reserve rates to be at different time intervals. Okay. So this is about as transparent as they can get over a long period of time. And it does give us a good idea of where mentally they think we're going to be at. A couple notes here. We'll point out the obvious. Basis points. 100 basis points equals 1% of a mortgage rate or of an interest rate. Okay. So if you see a 100 basis point reduction, that's 1%. You'll see 5%, 4%, 3%. Those are federal funds rates. So the transition to retail rates, which you'll get when you're buying a house, is around 1.5% to 2%, right? So if you look at today, year end ish, what they're expecting right around that 5%, that means right around the high sixes for mortgage rates, which is about what we're experiencing now. So they're saying that year end 2025, we should be seeing, maybe towards the high fives. et cetera, et cetera. So add 2 percentage points in, and that's where you'll probably see mortgage rates land. So the good news is they're giving the old college try to be really transparent on what this looks like on the Federal Reserve dot plot. Let's take a look at what actually is going on. The backdrop of this and what we're seeing, between inflation and everything else is pretty staggering, because if you look in the rearview mirror, we can see that before 2020, or excuse me, since 2020, 80% of every dollar in the United States has been printed. In the last handful of years, 80% of every dollar ever in existence was created. So pre-2020, for 200 plus years, we had 20% of every US dollar that's ever existed. And in just the last handful of years, we've printed 80% of every US dollar in existence. Now, to quantify that, what that looks like in dollar figures, we had 4 trillion in circulation at the beginning of 2020. Today, over 20 trillion in circulation, just to make an easy comparison of dollars in circulation today. A massive, massive jump. So here's the history. We have the dot plot by the Federal Reserve. So how transparent are they? Well, let's dig in a little bit. At the beginning of 2021, and again, I say this on every single thing that I go on. I'm a political independent, a political agnostic as far as it relates to anything economic. Okay. But it is worth noting January 2021 is when President Joseph Biden took office. Just a little sidebar so we understand how politics overlays economics. January 2021, the consumer price index, the rate of inflation was at 1.4%. Within about a year and a half, inflation spiked from 1.4% to 9.1%. Staggering, right? Staggering increases. Right around this point, very early, so early in the process, we had Miss Janet Yellen, the Federal Reserve Chair, the prior Federal Reserve Chair before Jerome Powell, saying at the top of her lungs, inflation is transitory. Inflation is transitory, meaning don't worry about it. It's coming, it's going, it's going to be gone before you know it, right? Not long after, we hit 9.1%. Inflation was very much not transitory, okay? Big problems ahead, because only one of two things can be true here. Either they thought it was transitory, okay, and they look stupid, if we're being nice, right? Or they knew it wasn't transitory, and we got lied to. It has to be one of those two. So if it's one of those two, neither one is a good outcome for the American, civilian, the American citizen. So since then, what have we seen? We've seen, like I mentioned before, the steepest rate hikes in history. The steepest rate hikes in history. So we've seen the Federal Reserve step in and rapidly raise rates at the highest rate that we're at rates that are the highest rates that we've seen since, about 40 years ago. More or less, inflation's a lot stickier and more stubborn and more difficult to keep down than we anticipated. So is it possible that the Federal Reserve did not understand all of the factors pushing inflation? So what is the impact of this? Again, we're here talking about net worth and how net worth gets passed around by generations. So what is the exact backdrop of net worth in the midst of all these inflationary pressures? One, we as Americans have lost 25% of our buying power in the economy. Okay. So if you had $100,000 in cash in 2020, you lost 25% of that if you didn't invest in something that beat inflation. Okay. Which at the peak was 9.1. So if you weren't making 9.1, then you were losing money at one point with the inflationary tail. Another way to put this is that dollars, which I was just kind of illustrating, dollars have lost over 25% of their worth. So very staggering and, concerning to say the least. All the while, unemployment has not spiked that crazy. Not as much as we thought, right? We've seen some of the headlines where they actually miscalculated unemployment and employment by about 1 million jobs. We'll get into that in a little bit. But overall, employment's been relatively resilient. I wonder why that is. Let's talk about that in a few minutes. Also, the impact post 2020 and the printing spree that we went on, mortgage payments have gone up over 111%. So we talked about the benefits of owning assets during inflationary periods. Well, look at the graph right here. Home prices are up over 45% in just a short period of time. So if you own a home, heck yeah, that's a very good piece of news for you. If you don't own the home, not a great piece, because between the home prices going up 45% and interest rates going from, 3s to 7s, your mortgage payment went up 111%. Very hard to enter the mortgage, or excuse me, very hard to buy a house and enter the home ownership realm when mortgage payments have over doubled. The stat offhand of affordability, it used to be that 45% of American families could afford a home. Now it's less than 15% in their local markets. That is a very scary trend. So, who's betting on inflation on a long period of time? Let's just name some big names. First, Rick Rieder, BlackRock, very big name in finance. Bill Ackman, Howard Marks. These are massive, massive names in finance. The purpose of this slide is to show you that big minds that are in the investment world are making big bets. We're talking, billions and billions and billions of dollars behind the long-term bet that inflation is an upward pressure for a long period of time. Very sticky. All three of these gentlemen have come out and said at least 10 years ahead. I think Howard Marks, no, I think it was Bill Ackman. He was just talking about 10 to 20 years was his outlook, long-term betting on the inflationary trends. So what we've seen, just a quick recap, huge rise in costs and resilient employment numbers. Very strange. Not usually the combination that you see in that. So yeah, we've kind of touched base on this about the backgrounds in rates and what we're seeing historically, because for the last 15-ish years, right, which we're talking about, we actually saw some of the lowest rates in history, those 3%, right? 4%. We're talking about rates that are historic lows that if you bought a house during that period of time, arguably you can't afford to sell. Especially, and look, I own a house that I bought right in the middle of this period, this 15-year period with the ridiculously low rates. I can't replace that house today for all the reasons that we just said. So I kind of have to stick with it. It's an investment property now, right? But I have income. I'm blessed with income and, I have my family. But if my wife came to me and said, hey, I think we should move. I think we should transition from this house to this house. And it was an identical house. And she was telling me that the mortgage rate was going to go up 111%. I'm out on that. And I have income, right? So there are generations, baby boomers being one of them, that's in the retirement era. What degree of interest do you think that they have in moving with looking at interest rates going up, with mortgage payments going up 111%? It's very low. The lock-in effect, especially affecting the baby boomer and retirement community, or the baby boomer and retirement ages, is very high. Most have no plans to move. If you look at the statistics, most baby boomers do not plan to move for 10 to 20 years, meaning they plan to spend the remaining years in the home that they're in today. That's the majority statistic. Very interesting when you understand that in the realm of the larger single family housing market. So, why did we have such crazy low rates for 15 years? Again, a big portion of this goes back to the baby boomer generation, the largest, most wealthy generation. But also, the last 15 years were kind of the heyday for the boomers. Y'all boomers had some great, great times in the last 15 years when you consider a few things. The first, your kids are out of the house. Your biggest expense in your lifetime stepped out of the house and they took their expensive bills with them. Majority wise, there might be some kids, some stragglers still, right? But overall, the highest expense a parent will have in their lifetime is their children. And the baby boomers had their children leaving their homes for college, to move out, to go get married and start their own families. The second is the last 15 years with the tail end of the average boomer's career. Okay. That 15-year window is when most people earned the most that they will ever earn in their entire lives. Why? Because they have the most experience in their career, one. And two, because they are in a position where that amount of experience is irreplaceable. There are not other people that can step into that role. So the replacement cost is very difficult. You can't swap them out as easily as maybe a frontline or an early worker in the workplace. Okay. That created a situation where boomers had extremely high income and significantly lower expenses. So what did they do with all that extra money? Okay. What we saw was they invested smartly, rightly so, right? Took after the greatest generation, were pretty conservative, maybe a little better, little more fun, maybe had a little more fun than the greatest generation, but they invested significantly. Boomers, you paid down your mortgages. That was one big thing you did. So your equity in your homes went crazy high. You created a ton of net worth by that. And the second is you invested into different things like real estate. You invested into different things like equities and stocks and bonds, etc. So what we saw in the boomer generation was a net worth boom, but so much money entering the market actually bid down yields. So with all that money entering the market, we saw rates go down as well, from that huge downward pressure of all that money coming in from the boomer generation's investing. Very, very interesting trend that we saw. Now, baby boomers are getting into retirement age or are already retired. It's well over the halfway point. So they're taking their money with them and going into conservative assets. That competition for yield in the investment space is not there. So that's a factor that's removed and driving rates up, one of the many. Also, let's get back to employment. I promised you we'd get back to employment. Now, what a remarkable trend to see all these borderline recessionary trends going on with high inflation and a lot of concerning things post-COVID, et cetera. But employment was so strong. How could all those things exist in the same universe, right? Well, I'll tell you, it goes back to that first chart. Gigantic boomer generation, under them small Gen X, under them gigantic millennial generation, under them small Gen Z. Okay. Big boomer generation had big millennial generation, but also small Gen X generation had small Gen Z generation. Okay. Boomers are leaving the workforce today, moving to the retirement age, we're moving to the retirement years. And who's replacing them in the workplace? It's Gen Z, the smallest generation that we've had in a very long time in the United States. Okay. So big generation leaving, small generation taking their place. That means employers are in a position where there's not enough people to fill roles. Okay. Gen Z being a small generation. Not only that, cultures change over time too. Gen Z is also the lowest labor participation rate that we've ever seen in US history. So it's a smaller generation and less percentage of individuals are working in the generation. So what does that do? That drives up employment, that drives up competition for roles, et cetera. Now, with that being said, employment numbers have been a little rocky lately and they've been getting readjusted, but the trends are very clear with the big generation being replaced by the small generation. We kind of covered this, on the last slide. So all that to be said, we covered a lot of factors, we covered a lot of opinions, and we covered a lot of reasons and drivers for this. But those are what we're seeing as the driving factors of why we're seeing inflationary pressures for 10 to 20 years ahead. Okay. So now we kind of understand the background. Let's drill down a little bit more on specifically the transfer of wealth and what that will look like. So the largest generation, the most wealthy, the boomers, are stepping away from the workplace. They're taking their money with them. And over the next period of time, sadly, will be passing away and passing the money down from their generation to the younger generations. The majority of the the majority of the recipients will be concentrated in the millennial generation, their children. Overwhelmingly, their children. Okay. Here are some interesting stats on what that looks like for those that will inherit money. First off, 60% of younger generation families, 60%, a very, very big number, will be receiving some degree of an inheritance from the boomer generation. Okay. That's a big impact. The average inheritance from the boomer generation to the recipients is around $300,000. Okay. Very, very, very impressive. That's big dollars ahead. Or that's big pressures. There's a ton of cash entering the market into one concentrated generation from the baby boomers. Not only that, 6% of millennial families will be receiving an inheritance above $1 million, which is the most concentrated and the most interesting stat that we've seen in inheritance in the midst of all this. Okay. It's very, very indicative of how this plays out on a larger scale when it relates to, concentration. Again, 40% has zero, right? 40% has zero. But the bigger driver is that we live in an economy, again, just to back up, 60% of millennial generation should receive an inheritance, and the average is 300,000. We live in a consumer economy. We're not China, which is manufacturing. We're not agriculture, which is other places in the world. We're a consumer economy in the US. So that amount of money passing through has downstream effects that are pretty profound, right? Especially when that money starts being back in motion in the markets. Let's talk about what that effect might look like. Well, our lovely boomers, you guys really like equities. You guys really like stocks. Okay. Disproportionately, you like stocks. Okay. And disproportionately, you like real estate, but not a ton when you look at your portfolios. The average baby boomer covers real estate and alternative investments around 5 to 10% of their portfolio. This is very interesting when you consider that younger generations have a much different view on how alternatives should operate in their portfolio and how equities should operate in their portfolio. So 55% of millennials have real estate near the top of their list for investment goals, things that they want to be involved in. The estimate is that real estate should receive 3x the amount of money than it did in previous generations, aka the baby boomer generation. So that looks like 20 trillion may enter the real estate market in search for yield and returns as money passes along to the younger generations and millennials. Staggering numbers. So why is that though, right? For one, millennials just don't trust the stock market as much. They don't really trust Wall Street as much. Millennials have a significantly reduced trust in Wall Street because think about the backgrounds of millennials. I'm one of them, right? I graduated college in the middle of the global financial crisis. Okay. So not exactly the best backdrop for the economy, right? It was roughly, the worst economic environment since the Great Recession. We've had all kinds of booms and busts that millennials have seen from a very young age. The trust in Wall Street is not the same as it was in previous generations that saw a lot more stability for longer periods of time. Okay. Just in the last month, I know a lot of people have been impacted by this. Stock market dropped about 9% in just a few weeks. The S&P 500, the best 500 companies in the US, dropped 9% in that short period of time, right? What doesn't help trust in equities, trust in stocks, is having big publications, whether it's Investor Business Daily saying they, believe we should be cutting stock exposure 20 to 40% in portfolios, or, even other names saying they don't advocate investing in stocks at all right now. It's just a more complicated outlook than when we used to say, oh, real estate, that's all alternatives. But stock market, bonds, those are real investments, right? Future generations do not hold the same outlook that the baby boomer generation had historically. So this is an interesting discussion. I have this with business partners. I have this with families or with my family. I have this discussion all the time where, we're talking about ups and downs and opportunities in the market. And I'm blessed to be around, friends and family that are very smart, very sophisticated financially, that I get to have really good discussions with. And the Saint Income Fund pays between 12 and 14%, depending on what share class you choose. So whenever I look at the market myself, I go, well, why would I ever take a risk here or there if there's opportunities that exist in fixed income 12+% a year? I just want you guys to think about that those exist out there. Those opportunities exist out there. So there's a benchmark. Investments have to operate above a threshold and have a degree of, confidence behind them, because there's alternatives that pay a fixed return of 12%, 13, 14% a year that are, in competition with that. So I always think about that as the opportunity cost of an investment along the way. I'd prefer to make 12% fixed rather than losing my butt, losing 9% in 3 weeks, other places. So now we know the money that's coming down the pipeline. Now we know who's receiving it. Now we know kind of the different mentalities and the different drivers of that. Where will this money be reallocated? Where will it be redistributed once it's passed along? And where will it be reinvested? Okay. This is a little bit about the Saint Income Fund. We're just giving you guys tools. If this is something that you want to take a look at, here's a link for you now. The QR code, you can get to that. It'll take you directly to a call page where you can book directly with Luke. He's on the call now, on the webinar now, and he can do a personalized investment strategy call with you, break down what you're looking at, what you're trying to achieve, etc. I personally have over $600,000 of my own money in the Saint Income Fund. We just had a deal close recently. I had about, 6 figures come back down the pipeline. I didn't find a better opportunity. I was actually looking for a better competitor to our own fund. I didn't see anything I liked. So also, if you don't want to do the QR code, you can text wealth to 949-787-0957. So a few different options to get in touch with us if you are looking for more information and want to invest in a fixed income strategy backed by real estate. Okay, so let's jump back in here. We talked a little bit about the background here. As mentioned, historically, when you're looking at the investment patterns of the baby boomer generation, about 5 to 10% of their portfolio was in the real estate space, the alternative space. With the wealth shifting mostly to millennials from this, the real question is what happens with their spending habits? What happens with their goals? Where are millennials different than the baby boomer generation that came before them, that they're going to be spending differently and driving our consumer economy? How are they going to vote with their dollars? So let's talk about the differences. Believe it or not, boomers, believe it or not, you may or may not realize this, but millennials are actually more risk averse than the average boomers and Gen X before them. Millennials are more conservative with their experience that we've seen with the global financial crisis and other financial turbulent times. Okay. Also, we talked about the lower interest in investing in stocks in general is just kind of a trend that is very interesting and, surprising to some. This is where it gets interesting. This next piece. Millennials are the beginning of a potential major shift where investing into things that have social impacts are a very real consideration. And I'll define that in a moment here, what real consideration actually means. Okay. ESG funds in the next 20 years are expected to surpass 50 trillion in capital behind ESG funds. That is a staggering number. So funds that are doing well for the, whether it's the economy or social causes or environment or whatever, have a huge, huge, huge focus by younger generations that will be receiving the, inheritances and the money coming down from particularly the boomer generation. This is where we're going to quantify what social impact importance means to the millennial generation. Okay. Now, boomers are all about all kinds of great causes. Boomers like to invest. It's very clear when you look at the trends and the opinions of boomers in all kinds of studies that they want good things for the world too, want amazing things for the world. The difference is what we'll see in this slide here. Boomers are unwilling to surrender any potential gain for social and environmental benefits. Okay, remember, these are the children of the greatest generation. Investing in the environment might not have been the most strategic choice in the middle of the Great Depression. Okay, so the boomers did not forget the lessons that they learned from their parents, the greatest generation. Millennials have a different opinion on this. Okay, millennials are willing to lose up to 10% of potential profit. We're quantifying it up to 10% of potential profit if the investment goes to a cause that has a social impact on the back end. Okay, so let's put real numbers to this. If it's a 10% return, millennials are willing to take 9%. Okay, that's 10% of the profit. So from 10 to 9, they're willing to forego 10% of the profit. Okay, boomers are not. That's a very interesting difference. We'll see what future generations look like on that. But it seems to be younger generations are more interested in social impact. Take me for an example. Saint Investment Group, one of the things that we look for is, we invest in mortgages. We buy distressed mortgages. We buy mortgages that were non-performing at one stage. Our first goal was to keep people in the homes. We wanted long-term investments. We wanted a long-term strategy. The best way we found to do that was by working with people to restructure, to modify their mortgages that kept them in their home for long periods of time. So it benefits the homeowner. It benefits the bank by getting these non-performing mortgages off their books. It benefits our investors by making a well above average return, and we make a few bucks too, right? So I'm a millennial. This is something that I see as well, and that we focus on at Saint. I think it's just a newer trend in investing that we hadn't seen in the past. So this is a little bit of a drill down. We'll start to get into some strategies that boomers are using to pass their money down to later generations. One of them that we're seeing here is called skipping a generation or throwing it over the fence, as I have some dear family that we get to talk about some high level and strategies with. Throwing it across a generation. And there's some reasons for that. Some are on par and some are very real, and others are maybe missing the mark slightly. Okay, so we'll drill down into that. Skipping a generation with the inheritance comes from a few big things that we see from the boomer experience of their lifetime. One is divorce rates and complicated family dynamics. Boomers have achieved amazing things in our economy, in our government, huge progress, a golden age for the US. Boomers also have very high divorce rates historically. Okay, the highest divorce rates that we've seen up until their generation. In fact, younger generations actually have lower divorce rates. There's a lot of conjecture around this, that boomers got married younger, that, the world changed at a different pace. There's many different things that came online throughout their lifetimes. But what we know for sure is divorce rates are higher in the boomer generation, and their family dynamics are complicated, much more complicated than the greatest generation or the silent generation before them. So they're concerned that their lifetime earnings, that their lifetime efforts in dollar figures might go to a complicated family dynamic for their children. It might go to somewhere that they don't want it to, right? Maybe someone they're not even related to. Those are valid concerns if your experience was a complex family environment and a complex divorce environment, right? The next is that this one's pretty real, that the next generation will piss away the money. Simply put, that if the boomer generation spent their lifetime accumulating wealth and working hard and taking stressful investment decisions and doing all kinds of things, that they'll give that money to the next generation and that they'll piss it away. So if they skip a generation, at least they know that that money will benefit two generations, not just one. So all of those are understandable. on that side. And there's times that is actually very strategic. But what we've seen consistently, once we start to see these play out, because the boomers are making their plays right now. The baby boomer generation is setting up the next, inheritance and succession planning financially right now. What we're seeing as these are the causes, these are the fears. What we're seeing as the number one solution most commonly is that boomers are finding the most success with long-term investment strategies. So that instead of trying to hope and, pray that their kids don't get divorced and that there's not some complicated family dynamic, or that their kids are, schmucks and don't work, or, take advantage of them. Instead, they're literally just putting the money in longer term investments and longer term trusts that protect that money and guide the money how the baby boomer, the owner of that wealth, exactly how they want it to play out. That's continually being the best strategy that we're seeing in the investment world. This is just one generation or a couple generations of the Vanderbilts to see how they, had some highs and lows. Cornelius, the initial, lion of the family, huge success. His son Bill took it to a whole new level. So Gen 2 actually knocked it out of the park in this instance. Next generation, Bill's sons didn't do too well. They pissed it away, not too great. But then next generation, Gloria, she killed it. She was amazing. Just one interesting generation. And this one we won't drill down on too much. This slide's very real. This is a very real way that boomers are spending their money, but it's also interesting. There's a small demographic of boomers, a small cohort that are believing they should spend every penny. So coming to a dive bar near you or a fun music festival near you is a whole crowd of boomers that want to have fun and be involved and have great experiences and spend every penny and die with zero. That's a very real discussion. There's books on this that are coming out. This is by far the smallest demographic, the smallest cohort of boomers, but there's very real discussions. I have friends that have this mentality that are, lifelong friends that are actually doing this. And, there's some benefits to it. They get to have a lot of fun, but by far the smallest cohort. The biggest question that we're seeing, whether it's in different surveys, in different studies, or in investment trends, is what do you want to be remembered for? Right? Kind of an intense question. And the boomer generation is defining that right now. What do they want to be remembered for? Because, there's the old saying, you vote with your dollars, right? So how are they wanting their dollars to vote for them? One, the highest consistently is that the baby boomer generation values the memories that they've shared with loved ones. That's powerful, right? Quality of marriage and partnerships, relationships, passions, hobbies, success and work career is not even top 3, right? In that regard. But so spending and investing into, loved ones seems to be a very high priority for boomers over the course of it. And what we're consistently seeing is not just the boomer trend of setting up trusts and things for long-term investment strategies, but we personally see this at Saint is baby boomers building in investment stability for the last period of time of their life. That is the big trend. That is the big story. They're getting out overwhelmingly out of things like stocks and things that are more volatile, especially in market conditions like today. We are seeing a big move to real estate, but not just any real estate. We're seeing fixed income investing have a huge, massive comeback where it wasn't that sexy for decades, right? It was not the focus of the finance world. So that's what we're seeing as a backdrop to things like shared memories with loved ones and quality of partnerships, marriage, relationships, passions, interests, hobbies, is that baby boomers want room in their life to not have to freaking worry about the financial side. They want to bunk in and get fixed things that they can rely on, that they can look after for potentially the rest of their lives to cover their bills. And remember, who came before them? Greatest generation, right? What are they remembered by? Their grit, their toughness, their legacy, their good example. I think the baby boomers take a lot from their book as far as what they want to be remembered for. And I think, they're doing a good job. I think they're doing a good job on that fact. So we touched base on this, the massive amount coming down the pipeline. These are always fun. Some common examples that we get are comments about investing in the world today. We've really drilled down on a lot of these, but we kind of talked about it. The reality is a lot of people looking for a smoother, more long-term investment strategy, something that's paying them on a regular basis and covering their biggest concerns. One minute it was COVID, right? And everybody wanted something that was not so impacted by COVID. Are you in office? Are you on these assets? Are you in the stock market dropping? What was it? 52% or whatever in a short period of time. So, stability on that side. So we constantly see these on our side. And, so at the very end of this, our answer to a lot of these trends was the Saint Income Fund. That's why we put the fixed income strategy together, that's what we were being asked for in the wake of these massive trends, in the wake of huge amounts of volatility. It was to put together a fund that paid consistently and was backed by real estate. That's a very important piece. Hard assets, physical assets that benefited from difficult times, that had 10 to 20 year horizons of big stability ahead, and even further from many of the trends that we were looking at while putting this together. So we'll dive in. I'll give you a little bit about the the Saint Income Fund so that you guys understand what goes into it and why the strategy that we're utilizing fits in with the broader discussion that we're talking about now. One is that the majority of our focus is on fixed mortgage rates. Fixed mortgages. We buy mortgages that had some degree of non-performance at a period of time. So maybe they missed 4 months or 6 months during COVID and they have that rolling balance. It's an opportunity for us to buy at a discount that same amount of mortgage, that unpaid balance of that mortgage, and to bring that current and bring that on a payment plan that has, 10, 20, 30 years left on that mortgage, right? We compile these, for a higher value, and we're able to pay out that 12 to all the way up to 14.28% returns on our high side. So that's our focus today at Saint. That's why we focus on fixed income, is because of the next 10 to 20 years ahead, that massive shift with trillions of dollars, right? That is the focus, and that's the reason behind what we're doing. This is an interesting statistic that's just, honestly, this is just a backdrop of the lifestyle of boomers and what they've experienced and where they're locked in at different places, specifically as it relates to single family housing. 43% of residential real estate in the United States, 43.2% of residential real estate in the US is owned by baby boomers. Staggering, right? Not only that, 20% of all mortgages in the United States are government loan programs. So if you add just those two buckets together, 63% of mortgages in the US are pretty dang rock solid, considering that the majority, 61% of all mortgages in the US are 4% or lower. So if 61% of mortgages in the US are 4% or lower, and since then mortgage costs have increased by 111%, right? Just in the last few years, what's the likelihood that these individuals are going to be moving anytime soon? Well, if you look at the surveys, most people are planning on 10 to 20 years in their homes today, right? And 98% of the mortgage market in the United States is fixed rate mortgages. That's unlike the rest of the world doesn't do it that way. So we live in a very, very, very interesting time in an interesting economy when you understand the broader economy worldwide. So couple notes, on fixed income as it relates to inflation. The reality is we've seen what inflation can do. We know that inflation could top out at 9.1% in a very short period of time. On our side, we see that the biggest combat against inflation is to have something that is beating inflationary returns and has those stable returns. So again, it's just kind of a little bit to see our background of what we're seeing